It's 11:01. We're going to go ahead and get started here. So to kick this off, let me tell you a little bit about myself. My name is Paul Ranieri, and my background is all things business, real estate, sales, and marketing. After closing over $50 million in mortgage loans in my first 6-month span as a mortgage loan officer, I knew that I wanted to be involved in something bigger, better, and where I could help more people. So this is why I transitioned over to Engineered Capital Gain Solutions, where I'm a deferred sales trust consultant, helping people defer their capital gains taxes on their highly appreciated assets. My role is to educate financial advisors, CPAs, brokers, and clients on how the deferred sales trust works and qualify clients to make sure the deferred sales trust is the right solution before introducing them to the trustees and tax attorney. Engineered Capital Gain Solutions is an approved trustee for the Deferred Sales Trust and is a family-owned trustee ran by the father and son team of David and Quinn Ellis. Combined, David and Quinn have over 40 years experience serving clients as fiduciaries in the financial services industry. When considering the transfer of assets to your children, I think it's pertinent that you work with a generational and innovative team of individuals with a proven track record of success, just like the Ellises. So real quick, a disclaimer, but I would also like to mention that if you are here and you're just looking for a get-rich-quick scheme, this is not it. So if you work extremely hard and you use this to add value, we have watched advisors easily add 8 to 9 figures to their AUM. The Deferred Sales Trust is the differentiating tool that is adding millions in AUM and building out advisor referral networks. And in this webinar, I'm going to show you how to implement the DST, how to add value to your current clients, and how to earn new business in less than 20 minutes. How does that sound? Good? All right, well, let's do it. So there are 3 secrets, and here are the 3 secrets we will discuss that advisors employing the Deferred Sales Trust use to generate high-value leads. Secret number 1, how to attract influential business relationships without sounding like the traditional advisor. Secret number 2, how to differentiate yourself from the sea of other advisors without lowering your fees. And secret number 3, how to increase your book of business without doubling your ad spend. So let's jump into the first secret. The first secret is how to attract influential business relationships without sounding like a traditional advisor. So how most advisors traditionally reach out to CPAs and other centers of influence is by offering something like increased revenues or revenue sharing, shared marketing and covering marketing expenses, enhancing their clients' experience and being able to now offer financial planning as a service or mutual referral partners and being able to send clients to one another. Now, these all sound great to you as the financial advisor, but your CPA doesn't need any of that. In fact, they've actually already heard that same pitch 3 times this week, and today's only Wednesday. So if that is you right now, don't worry. I do have an answer for you, which you're probably wondering, well, Paul, how are these relationships built then? Let me tell you with an example. So I went to get my tires replaced after getting a massive razor blade stuck deep inside. And the first shop that I went to by my house told me they would give me a 20% discount and it would be $1,000 for a new set of 4 since my tread was already running a little low. And it seemed a bit off. So I called up another tire guy who was, they were closing in 20 minutes and he got me right in, showed me exactly how he was going to fix it. And then he told me to call him in about 5,000 miles when my tread would actually be low. So he charged me nothing to do it, and he stayed after hours. Since that day, I've referred several people over to get new tires, plus I give them all my tire business. So what does this story show? It shows that strong relationships are built on solving problems for others without asking for something in return. Their foundation is built upon value and providing what others cannot. This idea goes hand in hand with your networking. So it's much easier to build on relationships quickly when you can offer something that solves a huge problem for them. So the Deferred Sales Trust provides the opportunity for advisors to collaborate with other professionals such as CPAs, attorneys, or estate planners to offer a more holistic approach to financial planning, which is what we will dive into on secret number 2. So secret number 2 is differentiating yourself from other financial advisors without lowering your fees. So like I just mentioned, the Deferred Sales Trust, it's an opportunity to branch out into comprehensive planning with your clients and even work with other estate planning professionals, being able to add extra value to your clients. This gives you the opportunity to position DSTs as part of a comprehensive financial plan and to earn more business from high net worth clients, such as business owners. You will be able to illustrate how DSTs can work alongside investment, retirement, and estate planning strategies to create a well-rounded approach for your clients. This also creates an opportunity to educate your clients on a tax deferral strategy other than one of the mainstream ones that they've already heard about. It gives you an opportunity to make sure they understand the benefits as well as the potential drawbacks, along with correcting any information from something they read online or something that they heard on social media. As you already know, clients appreciate advisors who will take the time to educate them about all of their options. They especially appreciate learning about options that are a little bit outside of the norm, which takes us to our next point, which is expertise. Advisors who thoroughly understand the ins and outs of the Deferred Sales Trust really position themselves as experts in a very niche area. Clients are more likely to trust advisors who exhibit deep knowledge of specialized strategies. And think about it from your client's perspective, right? Would you rather be given one option to put all your money into, or would you prefer to be given countless options to choose from with opportunities to diversify your portfolio? Of course, you're a financial advisor, and I use the keyword diversify. I know your answer. So let's jump in now to the third secret. The third secret is how to increase your book of business without doubling your ad spend. So the simplest way to make more money as an advisor is to solve a rich person's problems, right? So this is why finding a niche in tax savings is so important. I want you to take a moment and envision your clients who are business owners or, real estate connoisseurs. And if you were to sit them down right before their exit and you explain to them a strategy that could allow them to defer and potentially reinvest over 30+% of capital that would have otherwise gone straight to Uncle Sam, do you think they would be interested? What about your clients who maybe they're just tired of real estate? They don't want to do a 1031 exchange. They find Delaware statutory trust just far too restrictive. Now to you, would you prefer to manage accounts that are, after tax, already paying Uncle Sam its 30+%? Or would you prefer to manage the pre-tax account, making extra money for your clients? I'd be willing to bet a whole lot of money that you and your clients will both give me the exact same answer, and that they do not want to pay Uncle Sam more than they need to. And surely you don't want that for them either. No client in their right mind would rather have a $7 million investment account versus a $10 million investment account. Clients who are concerned about minimizing their tax liabilities while realizing significant gains will see you as an extremely valuable resource. Not only will they appreciate it, but you never know who they're going to brag to you about next time they're out on the golf course. When your client is selling a business or property, you are one of the people they should be calling, right? These are the moments where a ton of financial advising actually gets to take place. Your knowledge of the Deferred Sales Trust is one of the key components that will make your clients confident in giving you a call. So what is it? What is the Deferred Sales Trust? The DST is a tax deferral strategy, not a tax elimination strategy. The DST is a type of IRC Section 453 installment sale, also known as a seller carryback sale. Under this code section, the seller can achieve significant tax deferral benefits by not receiving actual or constructive receipt of the proceeds at the time of the sale. Instead, receiving payments made to them over time. Moreover, The deferred sales trust has greater flexibility than a conventional installment sale with respect to investment selection, risk management, and the repayment timeframe. So you're probably wondering as well, what can be deferred using the deferred sales trust? So let's dive on into it. So businesses, professional practices, commercial real estate is extremely common. Investment properties, and I will get into the 1031 rescue plan in just a moment. High-end primary residences, when the $250,000 or $500,000 deduction is not enough. Major stock positions, artwork, collectibles. We had a gentleman some months back who was actually looking to possibly sell a Picasso painting valued in the ballpark of $25 to $50 million, which I thought was pretty cool. But back to the 1031 rescue plan. So our structure can help clients save their 1031 exchanges. And let's use a common example, maybe where they cannot identify or close within the specified time constraints. Our structure provides a sense of security in knowing that if something goes south for any reason during the process, that they aren't left writing a huge chunk of their, pocketbook, a big check to Uncle Sam. So how does the deferred sales trust work? Let's talk through it with 7 steps. So first step, a client with a highly appreciated asset sells their asset to a third-party trustee in consideration of a secured DST installment contract. Second, the third-party DST trustee buys the assets. Third, the trustee sells the assets to the ultimate buyer. For those funds from the buyer, fund the trust in exchange for the assets. Now that the trust is funded, in step 5, the seller works with the trust's financial advisor to approve an asset allocation and note terms based upon their financial goals and their needs. The invested funds in step 6 are going to go to work and begin to generate an income for the client. Now, in step 7, the seller receives secured DST installment payments from the trust based upon the note terms. Anytime the client receives a portion of their principal, they do pay a proportion of capital gains taxes at that time. And anytime they receive interest as income, they pay income tax at that time. So how do we know it's legal, right? So our structure falls under IRC 453 as an installment sale. Now, I always like to mention that there are some knockoff strategies on what we do that use the same tax code but are in no way affiliated with what we do. So one of which that I like to make very clear that we are not related to is the monetized installment sale, which, for those of you familiar with it and knew about them not being able to close out audits and clients essentially taking constructive receipt, can obviously see why it didn't work. And it's been very clear for many years that it was just a ticking time bomb, really, for the IRS to formalize it as a listed transaction, which they recently did. Now, the deferred sales trust has been around for over 24 years now, with over 5,000 trusts created, and the structure has been audited by the IRS a little over a dozen times, and every single time, each case has been fully closed out with a no change required ruling. So audit defense, you're probably wondering, what if my client gets audited? Are they going to be on the hook for the legal fees? They would not be. Our attorneys are the ones that stand behind and defend their structure at no additional cost to the client. So let's walk through a sample case using a property owner named John Doe in California. So John is selling a rental property that he bought 30 years ago for $1 million. Today, he's selling it for a huge gain of $5 million, and $4 million of it will be taxed at a total of 37.1% in the state of California. John does not want to do a 1031 exchange, and he's looking for a way to postpone writing a $1.5 million check straight to Uncle Sam for him to never see again. In an ideal world for John, he would invest the full amount of pre-tax money with his advisor and look to generate somewhere between 4 and 5% per year to retire on. Now, the deferred sales trust provides him that flexibility to do exactly that. The DST provides our clients the opportunity to generate more wealth using found money so that they can focus on the things that really matter in life. So what does the process look like from start to finish? The process first starts with a detailed consultation with one of our specialized tax attorneys who will gather appropriate details of the transaction to determine if it is suitable for structuring as a DST, as well as the potential benefits, what the potential benefits would be to the taxpayer. Now, if the transaction meets the requirements for a DST and sufficient benefits can be obtained for the taxpayer, a conditional engagement agreement is offered to the taxpayer by the law firm. This engagement requires no upfront retainer whatsoever, and it does not obligate the taxpayer to pay for any services unless and until the closing of the sale of the appreciated asset and a decision by the taxpayer to proceed with the funding of the trust. The client works with their financial advisor and our team as trustee to understand their risk tolerance and determine their goals for growth and disbursement of the funds over time. Lastly, annual reviews are conducted to ensure that the client's goals are continuously being met and that they are satisfied with the investments and how they are performing. So right now, it does look like quite a few questions came on in, and I want to answer maybe 3 or 4 of them before wrapping up. If I don't get to your question, be on the lookout in your email. I'll contact you this afternoon. Let me pull all these up, and I want to answer at least a couple of these right now. Okay, so first question, really good question. What are the fees a client can expect to set this up? So there's actually 2 sets of fees. I briefly kind of touched on it during the presentation. The first set of fees is the attorney fee, which is a one-time fee that's about 1.25%. It covers the legal work and the audit defense in the off chance that the trust is ever audited. Now, the second set of fees is the ongoing fees, which are the trustee and your financial advisor fees, which we discussed with you. And generally speaking, those range between 90 and 150 basis points in total. Okay. Another great question here was, how do the fees get paid? Are they debited from the investment account? Is a separate bank account or money market account established from which fees will be taken? Is the trustee billing the client for the fees? So good question. Before the trust is structured, the note holder will actually sign our fee disclosure covering all fees that are involved in the trust. All the fees are trust expenses that are paid directly from the trust investment account. The trustee will invoice the trust for its fees after notifying the note holder each time. Okay. When is an ideal time to start exploring if the deferred sales trust will be the best solution for a client? So typically, we like to be involved once there's a letter of intent. However, we've had clients reach out, maybe months before closing, also within 2 weeks. I would like to reiterate, probably the best time is really when there's a letter of intent or when, an offer is accepted. But we definitely must be involved prior to the transaction taking place before the client takes constructive receipt. What are some of the things your clients wish could be better or were not a feature of the trust? Really good question. Yeah. I think, our clients and probably most, Americans in general wish that Uncle Sam didn't exist, right? But other than that, I think that the biggest thing clients wish that they could take all the money and buy personal items. They wish they could probably, buy a primary residence. That's one of the biggest things that we hear. And they can't do that within this structure because the IRS would view that for obvious reasons as constructive receipt, and they would need to immediately pay taxes on those funds. So I would say that that's probably the biggest things that clients wish they could change about it. I'm going to go ahead. I'm going to answer one more question. We're kind of closing in on that about 20-minute mark that I promised you guys on. So if I don't get to your question, be on the lookout. There are a few more in here. So I wanted to answer this one. When would this be a better fit than a 1031 exchange? It's a really good question. And I hate to give you this answer, but it really depends. It's going to be a better fit if a client, if they want to get out of real estate, right? If they don't want to maybe replace their debt in a 1031 exchange, if they want to sell and then they want to wait to get back into real estate at a later time. And, maybe those constraints that the 45-day window or the 180 days to close of the 1031 exchange just simply don't work for them. Those would be kind of when it's a better fit. But it does vary on a case-by-case basis. So usually that's one of the first conversations we're going to have with the client. All right. So I do want to wrap up with this. Obviously, after hearing this, many of you are going to do your own research on the Deferred Sales Trust, and I always encourage that. I just like to point out that there are others, again, that have tried to create their own variation of the Deferred Sales Trust and just simply have not had the success that we have over the last 24 years, as well as many individuals who are out there and they misconstrue the Deferred Sales Trust for one of those methods. So in fact, there's, I think I talked about it a little bit earlier, but there's a firm that follows the same 453 tax code that is now a listed transaction. So should you guys have any questions or would like to explore this further, if you have a client who you think this might benefit, please reach out to the email or the cell number on the screen. And I really appreciate you guys for coming. Again, if you have questions, feel free to reach out and I will get to the questions that I missed shortly. Thanks so much.